Good evening, once more, Zara. Now we can start. I'm sure you're able to see what is on the screen. Are you?
Yes, it's still on the financial modeling.
Oh, is it what I'm still sharing? That is not what I'm supposed to share.
Yes.
Okay.
Today I tried boxing for the first time at the gym.
Okay, that was good, and that was it.
I'm finished.
I can imagine.
I need to go and have my shower after this lesson.
Yeah. I can just imagine. Okay, so let's quickly look at this lesson so that you can have some quality time afterwards. Today, we'll be looking at leases, IFRS 16. I assume that, or I can prophesy, not even projecting, I can prophesy that in your new job, you will not avoid IFRS 16. There will be some certain times as an organization where you will actually rent some space, some apartment, some office, and definitely IFRS 16 will actually come very handy.
Oh yeah, at my current job, they we lease the directors' cars. The directors' cars are leases. Yeah, we have leases on them. That's about the only thing. And then the building, the land is freehold lease or whatever they it's just the cars.
So there will be this right of use asset. So you create an asset on this other part. The other side, you are creating a liability. Like I've always said, you cannot have an asset without equity or a liability. But because this is not, it's not you who bought it. So the other side, for it to balance, it cannot be equity. It can only be a liability.
Oh, yeah.
So this is not your office, but then now you have the right of use then of this particular asset, and it's called right of use asset. So the other side, it is actually going to create a liability for it to balance because you are introducing an asset which is ideally not yours, but you are actually using it. So how else would the balance it balance? It means that you are creating a liability. So a liability will actually fall on the other side so that your balance sheet, or what now you're calling as a statement of financial position, balances.
Yes.
It's that just that logic. Once you understand that logic, then whatever we're going to look at, it becomes much easier. So we can then now look at it.
Okay.
Yeah, please.
Do you want your iPad?
We'll be done soon. You're going to give him the iPad, please. It will be done soon. This lesson is not going to take a lot of time. It's basic logic. You know, financial reporting is logic, or maybe the way I teach is always logic. I don't want to complicate things.
I know, it's just the way you teach it, honestly. You have a way.
Sure. Thank you. So here now we go to definitions, or just a definition of a lease. As you are aware, a lease is basically a contract that gives the right to use an asset for a period of time in exchange for consideration. This consideration, usually, it is actually cash. You could have other ways of saying, we are going to lease this particular apartment, and the consideration will be that every year or every quarter, I'll be bringing 10 or 15 bags of corn or maize, as we call it here in Zambia. So a consideration can be different, but we know usually it's money, it's cash. Right? So that is basically the definition of what leases are. It is a contract that gives the right to use an asset for a stipulated period of time in exchange for consideration. That's it. So we then go to looking at the example. What is this particular lease? What does it do? A lease gives you exclusive use of a specific car. So you'll be told it's Toyota, it's yellow, it's whatever, it's specific. So to be a specific office, if it's a car like in your current job, where there are all these, it's a specific lease that has been given to your directors that you're going to use this vehicle. So you're not going to use any other vehicle other than this vehicle. It's a specific car. And you can decide when to use it and for what. So the car supplier cannot substitute or change the car because that car is specific. You have exclusive rights to use that car, which is an asset. So the question is, so does the contract contain a lease? Yes, this contract contains a lease because a contract that gives the right to use an asset for a period of time in exchange for consideration. Like I've said, I've explained what this consideration can be, but usually from experience, we know that the consideration is going to be cash.
Cash.
Basic rule.
16.
Leases recognize a right to use asset and associated liabilities on its statement of financial position for most leases. We had already explained that if you have the right to use an asset, certainly your balance sheet won't balance, or what now you are calling a statement of financial position. It is not going to balance until you have a liability down there. You cannot have an equity to balance it because this particular asset, it is not yours. You did not use any form of financing in buying it. So it comes in as a liability. You get it?
Yeah, wait, for most leases. So leases recognize the right to use an asset and associated liability on its for statement of financial.
Yes, there will be certain exemptions as we move on. Maybe that's why we are using this term for most leases. But as long as there's a right to use asset, you are going to create a liability.
Oh, yes.
Okay.
But you don't even put that. You don't even put that asset on your, it doesn't go on your balance sheet.
No, the asset goes on the balance sheet. The liability also goes on your balance sheet. That is now the new rules. Those days we used to have operating and financial leases. This time now, everything, because what others would do would actually use it. This standard, it was vulnerable for manipulation. Because then you can hide certain things. So it's mandatory that things should actually go on the balance sheet so that you're able to see them. And also your exposure. Because if you have gotten a lease, an office on lease, trust me, and this is the truth.
Yeah, I'm just trying to think on our balance sheet at work. I don't think it's there, the cars.
You check nicely. Maybe they don't specifically show them as right of use, but they should actually be able to show. If they are not doing that and they're calling it as a lease, then there's a problem.
Yeah, I'm just trying.
They cannot show it on their balance sheet. No, they cannot show it on the balance sheet because it's your company that is leasing out. So it's on the books of your directors. If they are the balance sheet, that is where they're going to show.
No, if they're leasing, no, they've leased. They're not. Yes. No, what do you mean?
It's the leasee, not the lessor. It's the leasee that will show those on the balance sheet. If,
the
for
person
example, Zesco goes into these malls and gets some space for their customer service centers, it is Zesco's balance sheet that will show these leases, not the lessor.
Oh,
because then you are saying right of use asset. So you cannot see
Yeah, so,
those lines on your financial statement because it is
so if my company
is a leaser.
has leased cars, if my company has leased cars, are they going to show those on their balance sheet? No. It's the company that
How do
owns
they show them? Yeah, they're not going to show them.
Okay, yeah, okay, that's what I was, okay, now I was confused. That's what I thought.
Yeah.
Okay,
Now you understand, right?
yes.
That's very good. So how do you
So
value
here
the...
we're talking about
Please continue.
talking. No, I was going to say, so we were talking about the person that actually owns the asset and leases it out. That's the one that shows the asset on their balance sheet, not the lease. C, the one who's leased it. Yeah.
You're not getting
Okay,
confused.
okay. Sorry.
It is the
Thank you.
one
No,
that is
I
using
think
that asset. This is why he has been given the exclusive right of use. He will show it or she will show it on his or her books as a right of use asset.
you see, you're
Then you
confusing
show
me.
a liability because you are showing the exposure to your organization. So you will not be able to see these things as long as it's your company that is leasing out those cars to your directors.
No, they've leased it from a leasing company.
But they have listed to who? To the directors. Or they have listed to the company.
Okay, so the company leases, takes the cars, and then they give the directors as a benefit.
So who is the leasee there?
It's the company.
Then they should show, if you are able to test that those are the leasee. If your company is a leasee, then you should be able to show it. But you should be able to test it. Maybe the company is actually acting on behalf of its directors.
Of the direct. That makes sense. That's why they're not on the balance sheet. Okay, now I see. Okay, and that's why we have to do the P11 at the end of the year. We do a form that goes to HMRC for them to pay tax, the directors, each individual director that has a car.
Now you understand.
Okay. Yes.
So how to value the liability? So the liability, you are going to use the present value of the lease payments. So all the possible lease payments up to end, then you bring them to today. So it will show the value of the liability. I know when you start looking at the numbers, it will start making sense.
How to value the right of use.
Yes.
Okay.
Then only how to value the right of use asset. On liabilities, obviously you look at the present value. On the right of use asset, this will include the lease liability, which is the present value of payments, plus all initial direct costs. All initial direct costs. Assembling your equipment, your chairs, all these other things, all those direct costs, initial direct costs, they'll be actually included as part of the value of the right of use asset. That's how it works.
Okay, thank you.
So after the initial measurement, you then now start depreciating these assets using straight line. Obviously, less any impairments, which is governed by IAS 36, a standard that we looked at some few days ago.
Yes, IAS 36.
So after the initial measurement of this particular asset, which I've already looked at, effective interest rate method, when you're amortizing the costs, we are going to look at these things comfortably so. So here's an example. You have entered into a 3-year lease term. Let me just get the
Annual in arrears. It's 5,000 each year.
yes. So it's 5,000 each year. So it's 3 years. Lease payments,
So
5,000
15,000
in arrears. So the rate
rent
implicit in
implicit in
this is actually 12.04%. Then we are saying that the present value of
is
these
12,000.
it's actually 12,000. So now you have these 4 conditions. That this lease is for 3 years, that you'll be paying 5,000 in arrears
Yes.
every year, and the implicit rate is 12.04%. The present value of lease payments as today is 12,000. So what then is supposed to be done? So we are saying the lease liability is initially the present value of future lease payments. So you have those lease payments, the present value today, which will give you the 12. Tomorrow, I know we'll try to do some few computations here and there so that you understand it. Today, it's just broad. So.
Oh, yes. Can we have, sorry, I forgot to remember I said tomorrow I got a shift. And
so we
it
can
finishes
have it let's have it on Saturday. Yeah, Saturday's fair.
Thank you. Thank you.
So we'll deal with the computations around IFRS 16 so that you get to understand how it works. I'll create some sheets for that. So if it's the double entry on this, you're going to debit your asset, the 12,000, and you're going to credit the liability account to the 12,000. So all you're doing, you have this, let's say 5,000 in year 1.
Oh, yeah, so you do
a calculator. Let's say 5,000 in year 1. So it will be times 1/1.1204. Let me just try to use, if you have Excel, then just try to use Excel.
Just use, this is a fun. What's this calculated? It's weird.
Yeah, so let me pick this first. So what you're saying is for 3 years?
Yes.
Then you have 12.04%. What else is there? Payments of 5,000. So you have 1, 2, 3. You have payments this side. Which is 5,000. Then you have your rate, which is 12.04%. This is more or less like your hurdle rate or your cost, your discount factor rate. So when you're starting the first one, will be 1 point, this number. Have I done? Pick a number like this. Don't worry. have something like this. This is your discount factor. In here, your discount factor would be this divided by 1 plus this number, lock it, take it down, these numbers here. So your present value of these particular numbers would be this payment times that. So enter of these numbers.
Oh,
So meaning that your present value, liability, and asset, you have this number here, which is 12, meaning that your present value asset will be this number here. It means that the asset will be debited, your liability will be credited. This is how it works. So you have in year one, these are years in case
yeah.
you forget. So you have year one, these are payments that you are making. The discount rate, which is your lease, implicit rate, which is 4.04%. These are the discount numbers. Your present numbers,
Okay, so
present
I want to
values.
see you in year two. Can you show me on the discounts there where you put 79, 0.7?
Yeah. So if you check your textbook, just check your textbook. The last part where you have discount factors, you'll see these are the numbers that are there. Get your textbook first, check, confirm, and pick at 12. It will not be that exact, but you'll be almost there because this is 12.04. Check the first one in year one. What will be it?
What's in the textbook, like an example?
No, not as an example. Your present value tables, every textbook has a present value, every finance textbook has a present value table.
Oh, really? So where will I find it?
Check the first page or last pages. There is a present value table.
Oh, okay. Oh.
I'll be surprised if your textbook doesn't have. It should have.
Maybe
So in the exam, you may not do the computations. You just go in the thing. Or even the exam paper. If you have an exam paper somewhere, even in that book, check if they have put exam papers, check the last page of that exam paper. There is a present value table. There should be. I know I'm an old school, but I know there should be. So it's possible that it can't be there.
Okay, so
check your mock exams in there. Check your mock exams. You'll be able to see the present
no, I
table.
just have this.
The annuity. Some will put annuity tables, but it's the same thing.
I've just got the text, study text.
No, even the study text, there should be. You should have a present value table.
Present value.
Research. Yeah. PV tables. 35. Present value tables or annuities.
What's is that? What's it?
Do this.
Yeah, just I'm in the class.
You'll fail to find it.
I tried to look at the on leases. Let me see. To determine the present value of lease payments not yet paid, the discount rate should be the rate implicit.
So every finance textbook must have a present value table. With whatever you're looking at there, you must have a present value table. I know
If
you
they
look
have
for
a question. Okay. I'll look for it.
Okay, look for it. So these are the discount factors. You don't need to know how to compute, but obviously it gives a bit of some edge if you knew how to calculate this. I'll give you an assignment to go and check those textbooks. You're going to find your present value tables. So this is how this number is coming in. Which
so where did you get O3?
No, but these are just formulas in here. Which O3? These are formulas here.
No, I was looking. Yeah, I wanted to see what you put there. And then the next one.
I'm picking this number and dividing by 1.1204. So it goes like that.
You're picking which number? The one above.
Yeah, but then don't worry. Go and check the present value first. Tomorrow on Saturday we can look at this.
Okay.
These numbers are there in the present value tables.
Okay.
Okay. But then Saturday I can show you how you compute this. Fair play, isn't it? Mm.
Yes.
So this is how I've shown you what to do there, meaning that you have the first 5,000 having this. So this is how you get the 12,000. I've shown you how you get your present values, which then you debit your asset and credit your liability.
Right.
Then because your asset, you have actually found that the asset using your present value is 12,000. But remember that this lease is only for 3 years. You're going to divide by 3 to start computing your depreciation. This is what then now you start getting. You start depreciating this asset using straight line depreciation method. So this is how now your amortization is going to work. You have your opening, the lease liability. The lease liability, the assets there to be using depreciation to be depreciated in 3 years. By end of the 3rd year, it will be actually 0. The other side, on the lease liability, you need to appreciate that you're actually going to have your interest, the same 12.04 that you're using. That's your implicit interest. So you calculate 12.04 of 12,000, getting the interest, which this interest 12 plus 1,445
We'll take away from this
minus the 5,000. It gives you 8,445. It's a liability. So you need to factor in interest as well. So that is what you're going to get. This number will come in here as an opening value. Again, you're going to calculate. You have a calculator there. Do you have a calculator?
It's rubbish.
No, but then you find time to buy a calculator. So you have this number. Again, you calculate this number here. You're going to multiply by this number. Here number again, you're going to multiply by this number to give you this number. Then you have this number this side. But maybe let's do it. Since we know what we are supposed to do, let me do this so that these things don't look strange. They shouldn't.
Oh yeah, I got that answer, yeah.
So now you have your 12,000 here. This is an asset. This is a liability. So this is the liability. For your asset, you are depreciating by straight line, isn't it, for 3 years?
Yeah.
So if it's an asset here, you have something like this. You have your 12,000, your depreciation divided by 3, which is 4,000. So in year 1, let me do this. So in year 1, you have, this is basically your right of use asset. Which will come here. Again, there you have this number here. Then you have this number here. You have this number here. You have this number here. This is the right of use asset. Are you getting me? So
yes.
again, here you're actually going to have your liability. So your liability here, you have your 12,000. You have your 12.5%, which is interest, which is 12.04%. You watch the video, you understand the concept. So you have this number, which is that number there. Which is this number here. Which then now, here you have your payments. Please understand the concepts. These payments, which is basically your 5,000, like this. So here, instead of picking there, we'll do this. So here now you have your closing balance. This is basically your opening balance. Here you have these numbers as your closing balance, which is that, right? Here you are going to have this number here as your interest, and you're going to have this number there as your interest. So your closing balance will be that. Then you are going to have this. So because of this rounding of numbers, this is why you are seeing that one there. Otherwise, you are not supposed to see it. It says you are learning financial reporting, indirectly also learning financial modeling from me without explaining what I'm doing. So this is how it works. So you have all these numbers giving you that. This is the whole thing that we're doing in here. You see, these numbers, they're familiar, isn't it? Yeah. From the Excel thing. So this is how you do your lease liability. Your asset or right of use asset is just the depreciation, the straight line that you're going to use and depreciate your PV asset or right of use.
Okay.
Again, another example here. I've already explained. On 1st January 20X2, Z company had a machine for a 4-year period under a lease with payments made in arrears. The machine had a 5-year useful life. Get a screenshot of this. And tomorrow on Saturday, you need to give me the answer.
Okay, let me take please I'll ask him to send me a picture. Oh, how do you take a screenshot on your iPad? Please pass me my phone. Sorry, can you please share the, pass me my phone, I'll take a picture. Thank you. Hello? Hello?
Hello.
I'm able to get you.
Oh,
Just take
sorry,
the-
yeah, it went away. Let me just. Let me take a picture, sorry. Okay.
Mhm. So we are saying on 1st January 2022, Z company hired a machine for a 4-year period and a lease. With payments made in arrears, the machine had a 5-year useful life. The present value of the lease payments at 1st January 2022 was $75,000, and the interest rate implicit in the lease was 8%. Z company incurred initial direct cost of $5,000. So from here, then we know that on 1st January, 20X2 was 75,000. These were the lease payment. The present value of the lease payments at 1st January 20X2 was 75,000, and the interest rate implicit in the lease was 8%. You have this direct cost there. They are saying, what was the total amount charged to profit or loss in respect of this lease during the year 20X1? So what was the total amount charged to profit or loss in respect of this lease? So you know for sure that you get this interest here. That is going to be charged to your profit and loss. Then you also need to appreciate that you're actually going to also have a component on depreciation. That depreciation, you need to actually check on the present value asset of use plus the direct cost. So this is how it's going to work. Asset depreciation, you have your 75 PV less payments plus your direct cost, giving you 80,000, which is this. This is your 1st January was 75,000, the present value, plus your 5,000, giving you 80,000. Then you divide by your economic use of period or years, which is 4, then it actually gives you, is it 20,000? Which is it, your useful economic life, which is 20,000 there. On the liability interest, you know the first period is just basically your interest, the things that we're doing, which is your 6,000. So you have these numbers, which would be your depreciation plus your lease interest or your liability, giving you 26,000. That is what is going to sit in the income statement. I
the
know
interest.
from not the interest, it's depreciation plus interest. The question
Oh,
is
yeah,
this:
the
what was the
depreciation,
total amount charged to profit and loss? So you have how much
Okay,
was charged to depreciation, how much was depreciation? You find that number, which is the 20,000, plus
yes,
the interest, which is 6,000, giving you 26,000.
yes.
So we now know that all these contracts mean we have to show a right to use asset and a liability. And I've shown you how you do your computations. So all you need now is to check in that textbook with 4 questions, start practicing. It's only practicing that you can become a guru.
Yes, that's true.
So there are also exemptions to leases. For example, if the period is just too short, maybe 1 year, then you can actually do the exemptions. If, for example, the value of this particular lease is also de minimis, it's also small, that can be exempted. If the lease is less than 12 months contract, unless there's an option to extend, if there's no option to extend, you can exempt. Just expense to the income statement and forget. Yeah.
Each class must have the same treatment. Okay.
Yeah. But again, if it's low value, just expense to the income statement and forget. But the choice is made on a by lease basis. That is what it is. So today's class, it is done. My only job now is to upload on my YouTube channel today before I start doing other things.
Oh, wow. You need to go to bed.
Yeah. But let me first send this, then I'll certainly do that. So tomorrow we are not meeting, but I'm meeting the modeling class. If you have a bit of some time while you're working the other side, you can just put the headsets and just listen.
Oh,
yeah.
Oh, yes,
just
I'll try
listen.
to do that actually. What time will it be?
I think around this, maybe around the same time. I think around the same time is fair.
So that was, where are we now? Yeah.
Okay,
So
let's say Zambian time, 20 hours.
Okay, that will work for you.
We can even start,
yeah.
Even 19.
I think at that time, okay.
At
So
that
you
time,
will
which
send
time
us,
was better, 19 or 20?
18. What did they say? I think they said between this time I'm doing it from morning, setting up the event. I think between 15 and 21, to be honest, it will be very quiet. Okay. So yes, so whatever, 19 will work, or 20, yeah.
Okay.
So I'll make sure I carry my headphones.
Okay, so thank you so much. Let me just upload this.
Okay.
Oh, you didn't check out. Sorry, as per tradition.
I was hoping you forgot. Okay, let me check out. Oh, I forgot you're uploading this. I was wearing a gown. It's okay. I'm wearing a gown. Okay. Can you tell?
No, we are not even able to see it.
Oh, okay, good. Yes. Okay. Very short and very good as usual. Very well. You explain things very, very well, and in a way that's easy to understand. So I think, yeah, what's my take from this? I've gotten a better understanding of what a lease is and how it works. The basic rule, I actually didn't realize in terms of the whole, on the asset side and liability side, to be honest. I just thought, so if you have a lease, it goes, because I think my company, it's not something I've really come across. It's just through theory, and obviously it's been many, many years since I did this, but this is helped me a lot, and I think it's going to help me in the future, like you said, for my next role. Yeah. For my next job, yes. Thank you very much. Okay, thank you so much, and bye-bye. I think now I deserve to rest. Yes, have a lovely